Access to Capital Teleconference is a monthly call. We feature an active lender that's deploying capital in today's real estate market, along with a group of industry professionals that keep us abreast of the trends in the industry and the heartbeat of what's going on. The idea of the Access to Capital Conference is to make it easy for real estate industry professionals to access capital, to stay abreast of the marketplace, and to network with the other industry participants and professionals. The call format is pretty simple. It'll last about 45 minutes. Initially, I will be introducing our group of industry professionals to tell us a little bit about what they see happening in today's marketplace. And then after we have comments from the industry professionals, we'll move on to our featured lender. I want to thank our sponsors today for helping us bring the Access to Capital Teleconference to you. McKenna, Aldridge, Jeffrey Demure and Associates, Seattle Funding Group, and Loan Note Fund have been our sponsors for today's call, and I'm grateful for their support. If anybody has any questions along the way, you can use your telephone and you can hit the number 1 key on your telephone keypad, and we'll be able to see that you want to make a comment, and you'll have your telephone opened up to a public forum, and you'll be able to be heard from the call. So we're going to get started now right away, and I want to begin by introducing our industry participants today are McKenna, Aldridge, Jeffrey Demure and Associates, and Orange Coast Title. And we're going to be hearing from representatives of each of those companies to hear what's going on in the marketplace. So I'd like to introduce Rich Macaluso, the president of Orange Coast Title. He and I have done business together for many, many, many years, and Orange Coast Title is a very strong title company that's provided excellent service in projects that I've been involved with. And I'm grateful to have Rich on the phone with us today. So, Rich, I'd like to open up the forum to you and hear what you have to say about what you see in the market today.
Thanks, Craig. And is my mic live?
Yes, it is.
Okay, good. So, hello, everybody. Good morning. Thanks to Craig for organizing the conference. We're very happy to be a part of it and support it. I think that the timing is great. What we see out in the marketplace with home builder and commercial builder, developer, investor activity has continued to be strong. I think the timing for connecting the lenders and equity players with the people that need that is great. So we're glad to be a part of it. We're a 40-year-old title company. We do all of our production in the United States, which is different from a lot of our companies that are shipping that stuff jobs overseas. I think a lot of the deals we're seeing are tougher deals from a title standpoint and an escrow standpoint, and they need personalized attention from the management team in our company, and we do get involved and we get tough deals closed. So, I'd ask everybody to give us a chance at that. We work hard to get deals closed, and we're appreciative of being on this call. I want to introduce the 2 other players from Orange Coast, the First Vice President, Jim Aurelio, and also Celeste Freeman. So, Jim, I'm going to give it to you to make any comments you want. Celeste, and we'll get right back to Craig.
Great. Thanks, Rich. Again, I want to reiterate thank you, everybody. And Craig, thanks for putting this together. As Rich indicated, we are real proud of what we've done and our partnerships we have with so many different lenders and builders and developers. And I think that's what separates us from everybody else, that we do work very hard for our customers. So hopefully we can begin working with you all and answer any questions you may have, and we certainly wish everybody a very successful remainder of 2014.
Jim, what's the heartbeat with your customers? Are they optimistic about the market? Are they increasing their activity? What are you seeing?
Craig, that's a great question. I think I get asked that question probably 3 times a day. And I wish I had a great answer for you. But I can tell you that for us, we must be doing something right because we're very busy and we're getting busier, and that's great news. But on the lending side, it seems like it's up and down. I don't think it's as robust. Our customers have indicated this last 2 or 3 months, especially recently, this last month, that it seems to be slowing down a little bit for no apparent reason. I mean, everyone's got their own reason. It could be vacations, summertime, back to school, who knows. But it has slowed down a little bit. It's not as robust as what they thought it was going to be on the commercial lending side. But we have seen this last week and a half, 2 weeks, a little bit of a pickup. On the builder side, I think they've done pretty well, and I think everyone's pretty positive on a go-forward basis. Rates are still obviously very low. Inventory is getting built more and more throughout the state of California. So I think everybody's very positive right now. I just think everybody was expecting more. And I'm not quite sure what more means to everybody, but I think everyone just thought it was going to be a little bit more robust. But it's been very stable. In my own humble opinion, I love stability, so I'm happy with this.
All right, well, thank you. Celeste, how about you? Welcome back to the Teleconference Forum. It's good to have you back aboard.
Thanks, Craig. I appreciate it. I appreciate the opportunity to let us introduce ourselves. Great to have this forum to connect and share all the information and ideas that we have. Just reiterating really what Rich and Jim just said, that we've been doing this for over 40 years now. We've got some really experienced people, and we're real experienced at getting the tough deals done. And I think financing continues to be a problem out there for a lot of builders. So this also is a great forum to get them together and try to do business together.
Well, we're trying to make it as easy as possible for builders to get back into the marketplace, for real estate industry participants to be able to finance their projects. And the idea is to make it as simple as possible and to provide a team of experts like you to be able to provide the expertise needed to help bring the project off the ground. And actually, Aaron, did you have a question?
Yeah, I do. This is Aaron with HomeStreet Bank, and I have a question for Rich or Jim or Celeste, whoever wants to maybe respond. And I'll give you a little bit of my history later on in the call, but having gotten back on the production side after about 6 years doing workouts and REOs, one of the things that we're experiencing now as we're trying to get loans closed is kind of the new concept in terms of the lender's title policies and this concept of incremental coverage, which is creating heartburn for a lot of lenders, including myself. And then the documentation that's being required, at least on its surface, and it seems to be a little bit negotiable, but the documentation that's being required for breach and priority coverage and the documentation being required for each disbursement under the loan, to obtain our 122 endorsements, which, from my standpoint, has changed considerably from the last cycle. So can you address how you're working with your lender clients to try to overcome some of these title issues?
Yeah, this is Rich Maclus. So I'll address that. And I think that's perfectly correct. The title insurance underwriters around the country during the last downturn were stung badly by claims, and in particular mechanic lien, and it's, relative to priority breaks and those types of issues. So the entire industry has tightened down tremendously those requirements and those approvals and the actual structure of the loan policies on commercial, especially when there's recent construction or current construction going on. And so what we are doing to address that is we're meeting with all of our underwriters, making sure we're very clear on their requirements, and then trying to talk to our lenders and our borrower clients at the beginning of a transaction versus at the end, and talk about those issues and say, let's address them right up front. And let's make sure we get that documentation in, and don't break priority is probably the biggest word we're spreading. It's a very difficult, it used to be almost matter of fact that the title industry accepted indemnifications, break priority, don't worry about it. That's almost an automatic for any upstanding builder, developer with history. And that's not the case any longer. And so we have to address those issues. We start by asking and requesting that you just plan your project with record the construction loan and then start all the work. And when we can't do that, we need to attack it very early in the process and get to the underwriters. And there's some exceptions available, but they're not like they used to be. So I think being aware of that situation and starting to talk about it very early in the process on every transaction, every loan, every project is really important these days to avoid last-minute issues.
Right. No, and I understand that, and we kind of preach the same thing to our developers, but you know how it is. That kind of goes in one ear and out the other. But, I think I understand the concept of incremental coverage, but could you just kind of touch on that and exactly what that means and how that works?
Well, if you do understand it, you're better than me. I got to tell you, I do not understand it. I hear the requests, and I let our legal counsel and our senior underwriters get in the middle of that question. I just know that we've been able to get 2 deals done where we were able to change that incremental coverage to something more acceptable to the lender. And most of the time they won't make exceptions on it. So the legal, technical understanding of incremental coverage, I'm going to need some help from either any of the attorneys on the phone that understand it, or we could schedule another, on the next call, I could have our general counsel on the phone and have him explain it, but I don't want to attempt to do that.
Yeah, I'm going through it right now, and what I think it means, mechanics lien and priority issues aside, I believe it means that if you have a $10 million construction loan, in the past, you got a policy that covered, it was a $10 million policy from day one.
Right.
Now I understand the way it works is that you have a policy where you have coverage up to $10 million, but it's really limited to each disbursement as you go. So
that's correct. That's my understanding.
On day one, if you'd make a closing advance of $500,000, you've got $500,000 worth of coverage, and that builds as you work your way through the project and make disbursements. Is how I understand.
The amount of coverage increases with the amount of disbursement. Absolutely, that is my understanding as well.
Okay, and as long as those disbursements are approved and you get a 122 and everything's clean, yeah, that's kind of the way I understand it.
You have to stop at every disbursement and provide paperwork and file information to have an approved increase in the coverage. Yeah.
Right. That's kind of what I understand it to be.
Yep.
If any of the attorneys want to chime in and
well, actually,
tell me I'm wrong or I'm right or I'm close.
Well, I'd like to move on for a minute to Tom and David Kraus-Lehman from McKenna, Long and Aldridge. McKenna, Long and Aldridge is a international law firm with 575 attorneys, and Tom Winfield has been my friend and legal counsel for many, many years, and we've been happy to have Tom and David featured on several of these teleconference forums, and we're glad to welcome you both back here today. Tom, David, what are you seeing in the market today? And if you want to comment on Rich's and Aaron's issue, that you would be welcome to do that too. But let's go ahead and see what you guys are up to today. Tom?
David, what do you have to say?
Yeah, well, I'll be happy to comment on the issues that have been addressed in a minute. Generally, what I'm seeing in the market today is, no surprise. I think it's accurately reported in the news as to what's happening, at least in Southern California. The home starts are down, but we've got quite a bit of apartment and commercial construction going on. There's a lot of projects in the pipeline. I think the projects are becoming more difficult, particularly in the Los Angeles metropolitan area, where a lot of the projects are infill-style projects, which present more challenges than simply turning raw land into something new. So those are the kind of projects we're seeing as things that are more challenging. I think there's plenty of demand out there. I do agree that the building recovery seems to be somewhat slower than people thought. They did think there would be more activity, but I think probably steady is better than too fast. I don't know yet that we can say there's too much multifamily residential in the pipeline, because certainly in the LA metropolitan area, prices for rent and homes are still very high, which suggests that there's still a lot of pent-up demand.
Whether we see a little bit of a slowing coming up or not, I don't know. I think it's a little too soon to tell. But I do think that there's still quite a bit of demand out there for more housing, at least until we see, the affordability index starting to come in line with what's being produced. With respect to the incremental coverage issue, I believe that it was nailed in the last few comments. That is how the incremental coverage works, is that coverage increases incrementally as lenders disperse funds. And that's because I think too many title insurance companies got burned during the last downturn with full coverage type of policies where lenders had dispersed, after pre-start and things like that. So it is an effort by the title companies to limit their exposure on projects to only what's been dispersed and to increase that coverage as they go along so they can keep better track of what's going on with the projects.
Thanks, David. There many callers have dialed in since we made the initial introduction on the call, so I just want to welcome you all to the call. If anybody who has dialed in and who is listening to the call has a question for any of our participants, all you have to do is hit the number 1 on your telephone keypad, and it's like raising your hand. I'll be able to see that you have a question and then be able to announce you to the group with your question. So feel free to do that. Right now, we're hearing from industry participants from McKenna, and Aldridge, Orange Coast Title Company, and then we're about to hear from Chelsea Richardson from Jeffrey Demure and Associate Architects about what they're seeing in the marketplace, and then we're going to move to our featured lender today, HomeStreet Bank, in just a minute. So, Tom, did you have anything else to add to Tom Winfield from McKenna, and Aldridge? Do you have anything else to add, what you're seeing in the marketplace?
Just as an the market, as everybody appreciates, is something that I've been doing this 40 years, and I've never really understood what the market's going to be, and we're always anticipating it. I have recently gotten re-involved in Playa Vista, a planned community north of LAX in Los Angeles, where Brookfield and KB Homes and TriPoint Homes are building 2- and 3-bedroom condos, townhomes, in an elegant planned community where they are selling as fast as they can get these structures up, 2- and 3-bedroom units starting at $1 million, and with the options built into the program easily getting to $2 million. And they seem to have no end of buyers. And it always strikes me that at some point in time, we're going to run out of buyers who can afford $2 million homes. But it hasn't happened yet. Our clients who are in the Central Coast are seeing a very active market, but the home prices up there are substantially lower, and the incomes up there are government generated typically, so they're lower than we have in the buying market in Los Angeles. But it is it's a dramatic proposition to see something that was planned very successsly 8 or 10 years ago. The first phase of some 3,000 units were built as two-bedroom co-ops, townhouses, and the professionals all thought that was going to be a good starter market or downsized market, but people wouldn't raise families in communities like this. And what we're seeing, people who bought a two-bedroom are now looking to live in the same community with a three-bedroom home, and these new developers have come in and are giving them dramatic product that 20 years ago, 25 years ago, just didn't exist. So one of the things that we have to watch in this business is what the buying market wants. That's certainly not a legal observation, but nobody needs lawyers until they miss the market, and then everybody needs a lawyer. Go ahead. I'm sorry. Greg?
Chuck Salas, I think, has a question. Chuck, are you on the line?
Well, yeah, I am. Thanks, Craig. This is Chuck, and I wanted to just comment briefly on what Dave or Tom were saying, and that is that the demand is as uneven as the recovery. So as a lender, we're seeing an extreme amount of activity on the west side, whether that west side be the west side of L.A., Orange County, San Diego. And because that demand is so heavily oriented to the west side, it necessitates the infill projects. Going back to the title issue, I had met with Rich and Celeste some time ago, and we discussed at length the issue that is it Aaron with HomeStreet Bank?
Aram, welcome back on. I saw that you dropped off for a second. Aram and Anthony from HomeStreet Bank,
okay.
And they haven't given their presentation yet. I noticed that you jumped in a little bit late. They're going to be giving their presentation just a second. And Aram, the question is coming from Chuck Salas from Seattle Funding Group right now.
And it isn't so much a question; it was a comment that hearing Aram's questions to Rich and Celeste with regard to the broken priority. In meeting with Rich and Celeste, they were extremely helpful, and in meeting with others in the title industry, what we found was that we had success in securing, and we have had success in securing mechanics lien endorsements without the incremental coverage, and we had this discussion with Rich and Celeste as well, and they were very helpful, really predicated on having extremely detailed documentation and proof of payment and release of liens from anyone who had touched the property up to the point that our loan was going of record, and equally important that our controls in budgeting review and fund control and oversight really ensured that not only did we have the money to make certain that it was finished, but that our controls made sure everybody was paid so that the exposure to the title company was really negligible for anything that was unpaid as of the time of close and covered afterwards. And really with the strength of that package, and we, again, Rich and Celeste were very helpful. With the strength of that package, they and others were much more willing to accept and issue mechanics lien endorsements without incremental coverage because we haven't been able to wrap our head around and get comfortable with accepting incremental coverage. So we've been able to pretty much close all of them that we wanted to close without that incremental coverage, even with broken priorities. That's it, Craig. Thank you.
Thank you, Chuck. I appreciate your input. Thanks for joining us today. The next person, Chelsea, I don't want to catch you off guard, but are you available to give us some thoughts on what you're seeing in the marketplace and what Jeffrey Demure and Associates is up to these days?
Yeah, I'd be glad to.
Welcome back, Chelsea, by the way. I'm happy to have you back on the teleconference forum. It's really a pleasure to have you here.
Thanks, Greg. I'm glad to be here. Okay, so we're coming from a different perspective. We're architects and planners, so we look at the future. We do a lot of planning, so we're looking at what's the next thing in the community. We're seeing a big trend towards unique story-based communities, and by that I mean you don't name the community after the amenity you destroyed to create it. You actually, find a good story and have meaningful open spaces and the new kind of amenity, which is likely not a community center or clubhouse rather. It's walking trails, maybe it's an urban farm, community gardens, things like that. From a design standpoint we do single family, multifamily, and older adult work. Single family, what we're seeing is that buyers are not willing to compromise when it comes to traditional homes. So if you're presenting a home that is a traditional two-car front load, the very standard home, buyers are not willing to compromise and put that home on a smaller lot, have a quirky floor plan that doesn't make a lot of sense. However, if you're presenting an alley load or a motor court or something that's a unique planning solution, then they're willing to compromise. We have a project near us here that has, in Northern California, right across the street from each other, the same builder built two product lines. They built one that's alley load and one that is two-car front load, but on a small lot. And the alley load outsold the small lot two-car front load. So even though you've got a compromise in the form of an alley-loaded home, those homes were easier for the buyers to understand and wrap their heads around than a two-car front load that has constraints that they're not used to in the form of a really small backyard and the room arrangements. Multifamily, I echo what everybody has been saying. Multifamily is still going crazy. We've got a lot of apartments in the pipeline. And from an older adult standpoint, we're still seeing a huge movement in replacing the old school, older adult facilities, assisted living, memory care, independent facilities that were built, 30 years ago with current facilities that are going to really appeal to the baby boomers. So that's kind of in a nutshell, the different buckets of work that we work in and what we're seeing in each of them.
Perfect. Thank you, Chelsea. I appreciate that. We have a question from William Hamilton, who's on the line. William?
Thanks, Greg. Thanks, everybody, for being here. Chelsea, this is a question for you and any others who might want to chime in on this. I'm hearing from a lot of architects that a increasing movement is more toward the micro unit, meaning, sub 500 feet, and that there is an emerging market for that. I am a skeptic. I haven't seen a lot of play in that, and I haven't seen a lot of demand from the people with whom I speak about it. What has your experience been with it, and do you see that as a continuing trend, or is it more a creation of media?
I think that we're on the bleeding edge of that trend. I think it will be a trend. I'm not sure I would call it a trend quite yet. I think that it's getting a lot of traction from a buzz standpoint. People are talking about it. People are very interested in it. There's definitely I think that what we would say is there's a trend towards or away from the house that got people in trouble during the downturn. So what was that house? That was probably too much house, more house than they could afford. It was likely suburban. What we're seeing is a trend certainly smaller, but we're not quite getting to the micro house yet. I do think it's coming, though. It just may not be within the next 3 years.
Chelsea, do you think that it's coming strictly through financial considerations, or are people actually having a change in their lifestyle or being more comfortable with the smaller units?
I think it's a lifestyle. I don't think necessarily it has to do with being more comfortable in smaller units. I think it's more about what do I need to live and how can I live my best life. And a lot of people are seeing their best life being not sitting at home and watching TV, but being out and having adventures and traveling. So maybe if you've got a micro unit, you can have 2 micro units in 2 different places that you want to live. It's less about the home as your kingdom and more about the world as your oyster.
Is there anybody who could comment on that on the call this morning from a lending point of view and a funding point of view that could shed light on, is this indeed something that lenders are looking at with more favor?
Can I ask that we defer that question to the lenders after their presentation? We're going to move into that. I'd like to move into the lender presentation right now, and then at the end of that, you'll have the opportunity to ask the lender that question as well, HomeStreet Bank. I want to introduce Aaron Palladian and Anthony Lapalato from HomeStreet Bank as our featured lender today. HomeStreet Bank is a $3 billion bank headquartered in the Pacific Northwest. They've just expanded their activities to California and Hawaii, and engaged, brought Aram and Anthony on board to help with that program. I've known both of them for many years. I met them originally at Imperial Bank many years ago, and then Aram moved on to Key Bank, and they've recently joined forces together here in Newport Beach to create a new lending presence. So, Aram, welcome to our call today. Aram and Anthony, I'd like to hear from you. How are you guys today? Thank you for joining us.
Just to introduce HomeStreet Bank, who's relatively new in the California market. We've now been in business here for about 5 months. Just to fill in a few gaps in HomeStreet Bank and who we are, we're actually a Seattle-based Washington State chartered bank. The HomeStreet has actually been in business for about 90 years. They started as a single-family mortgage bank, and that continues to be a very strong product for us. They've been doing construction financing in the Pacific Northwest for probably the last 60 years. And about 6 or 7 months ago, I was approached by the CEO of the bank who wanted to expand their construction lending platform into California. So we've been open for business basically since April 1st. I like to say we're doing conventional bank construction financing. Our developer profile is more I'm going to say the upper tier, privately owned merchant builder. Financing the public or the semi-public and participating in their large lines of credit is not the type of business we're pursuing. We're looking to be the lender to the merchant builder, segment of the market. Our products are pretty consistent with what banks were doing in the last cycle. We'll do A&D financing. We'll do vertical construction financing in the form of phased construction loans, construction revolvers. So there's a lot of flexibility on structure. We will not interested in doing speculative A&D type financing where, the lots are being developed and flipped. Our A&D loans need to be tied at some point to a construction loan for the developer. We are a recourse lender. Our rates and fees are pretty competitive with the market. A lot of that depends on risk, length of, the term of the loan, where it is and what it is. But we're finding that we're very competitive with the banks that are back into the same segment of the market as we're pursuing. Not all the banks have gotten back into the residential home builder construction business. That seems to be increasing, more and more every day. But we're having a fair amount of success. Going back to a lot of between Anthony and I, we probably have over 60 years experience in this marketplace in the home building business here in California. So we have a lot of contact, and we've gone back to a lot of our previous developers that survived the recession and are having a fair amount of success and are getting busy. I've hired an underwriter. We've just hired a processor, so we're still building the staff here in Newport Beach. As Craig mentioned, our territory is all of California and Hawaii. HomeStreet Bank has branches in Hawaii, and we did business over there with 3 or 4 developers before the recession. Did very well, got out, no problems. And so we've gone back to some of those developers and are looking to reestablish our presence in that market as well. So needless to say, we're getting pretty busy. Anything to add?
The one thing I would add is is we're truly a relationship bank. We're not interested in the one-off transactions with an investor that has a lot of money and wants to build one project. I think Aram touched on it, but I think relationships are key to us. We don't want to do one deal. We'd like to do all their, handle all their banking needs. Even though all our branches are located in the Pacific Northwest, we can handle the deposit sides also. We have computerized systems that allow us to handle deposits from developers to create a full banking relationship. And again, the early stages kind of different from the last cycle, but a little, same concept. There's a big drill down early on into the financials of the borrowers and the guarantors. So just to make everybody aware of that, you really need to have all your financials ready to roll when you come in here. And again, we do a lot of financial analysis now, but it's quick, and we have great guys that do it, so we understand that global concept of people's financials is a big thing with banks nowadays. So that's something that, again, early on, we really want to understand the financial picture of the developer along with the real estate now.
Yeah, and I guess just to add, a lot of these concepts of analyzing borrower financials, global cash flow, knowing your borrower, a lot of those concepts are being driven by the regulatory agencies this cycle, and those are things when they come in and do their annual or periodic audits, those are things that they definitely focus on when they come in and audit the files. So it's not the banks. We're kind of being driven by the regulatory environment that we have to operate under these days, which is a lot different than it was during the last cycle. The other thing I will add too as well is our loan size. We've set our minimum at about $2 to $2.5 million. We'll go under that if it's part of an overall relationship. On a single transaction, we can probably go up to around $20 million is kind of our house limit. And then we can probably do 40 to 45 million on an aggregated basis with any one developer. There's ways around that as well by doing, participation or selling down portions of loans with other lenders that we partner up with. So, that's kind of pretty much of a thumbnail. The other thing I should add is one of the things that kind of excited me about coming to work for HomeStreet is it's one of the first banks that I've worked at where we have the capability to basically provide kind of soup to nuts financing for the developer. And what I mean by that is we can not only do their A&D and their vertical construction, but as I mentioned earlier, HomeStreet is very big in the single-family mortgage business, and we have a very large builder services group that can go out and work with the developers, sit in their model complex, qualified buyers, and do the end loan for their buyers. So we can cover the full spectrum of financing for our developer clients, which to me is exciting. So with that, I'd welcome any questions you might have for myself or Anthony.